Today, do the recession sirens call? Hello again, it's Martin North from Digital Finance Analytics, world latest posts covering finance and property news, and this is our weekly market update. Well, last week was quite a week, with the start driving markets higher in an AI-induced hallucination before the reality of rates higher for longer hit home, thanks to Federal Reserve Chairman Jerome Powell's testimony, in which he signalled more interest rate hikes ahead, but did vow that the central bank would proceed with caution. And of course, the Bank of England lifted 0.5% to 5%, a 15-year high, as recession talk came to the fore, supported by a range of weak PMIs. And in fact, on Friday in the US, all three major stock indices lost ground in a broad sell-off. Interest-sensitive mega-cap stocks weighed heaviest on the tech-laden Nasdaq, led by Microsoft, Tesla, and Nvidia. All three indices actually notched weekly losses, ending a weeks-long rally. The Nasdaq snapped its 8-week winning streak. That's the longest since March 2019, while the S&P 500 broke its 5-week rally, its longest since November 2021. The S&P 500 and the Nasdaq logged their biggest Friday-to-Friday percentage drops since early March, when the regional banking liquidity crisis hit. It's been a bit overbought, the market, and giving a bit back now, says Ross Mayfield, investment strategy analyst at Baird. The rally has been momentum driven with fairly broad participation, and there's nothing surprising about markets taking a pause, and the pause has been fairly orderly. San Francisco Fed Bank President Mary Daly said on Friday in an interview with Reuters that 2 or more rate hikes this week is a very reasonable projection, while echoing Powell's call for more caution in policy decisions. And Atlanta Fed President Tom Barkin said late on Thursday that he was unconvinced inflation is on a steady path down to the 2% target, but added that he would not predict the outcome of the central bank's July policy meeting. Financial markets have baked in a 74.4% likelihood that the Fed will resume hiking the Fed funds target rate by another 25 basis points at the July meeting, according to FedWatch. You can probably count on a rate hike next month, but it's that second hike that the markets are skeptical of, Mayfield added. I'll be surprised if the inflation data and other economic data merits that second hike by the time we get to the September Fed meeting. So the Dow Jones Industrial Average fell 0.65% to 32,727. The S&P 500 lost 0.77% to 4,348, and the Nasdaq Composite dropped 1.01% to 13,492. Actually, all of the major S&P 500 sectors lost ground, with utilities suffering the largest percentage loss. Chips weighed on tech shares, with the Philadelphia SE Semiconductor Index sliding 1.8%. The 10-year to 2-year curve is burrowing southwards, perhaps for a test of the inversion low earlier this year. While people tend to worry that a yield curve inversion is a trigger to economic recession, it's actually the steepening that follows that usually brings the trouble, whether it be inflationary or deflationary. Today's situation tests the inverted levels of noisy events of the late 1970s and early 1980s. After a couple of recessions, that situation resolved pleasantly into disinflationary as opposed to outright deflationary settings, as the resulting steepening after several stops and starts never did become an impulse, nor did the next yield curve inversion in 1989 also lead to the same recession. The gold bull, of course, is trying to hang in there despite the less than perfect macro picture. The friend-end August gold contract on New York's COMEX settled at $1,930 an ounce. That's up 0.3% on the day, but earlier in the session it had fallen to $1,919. That's a new low since mid-March. For the week, the benchmark for COMEX gold finished down 2%. That's the sharpest drop since the end of January. For June thus far, the contract is down 2.6% after a 1.8% slide for May. Notwithstanding those monthly losses, it is still up more than 5% on the year, though. Gold took a hit this week as the dollar rebounded after the Bank of England raised interest rates by half a percentage point, twice more than forecast, saying it needed to act against significant indicators that British inflation would take longer to fall. UK's main interest rate is now at 5%, that's the highest since 2008, after the largest rate increase since February. The UK Central Bank has raised rates for 13 consecutive times to trail just behind the Federal Reserve, which has brought US rates to a peak of 5.25% with 10 straight rounds of tightening. The Fed itself indicates that it wants to raise rates at least twice more before the end of the year. If swap futures start to believe the Fed will likely deliver 2 more rate increases, gold could remain vulnerable, said Ed Moyer, analyst at online trading platform Onya. However, if risk aversion runs wild, gold could see some flight to safety following. Gold has key support levels at 1,900 and resistance at 1,960, he said. At the risk of reiterating the message to the Saudis and the rest of OPEC+, it's the same message. More patience is needed with oil prices. Crude markets posted a weekly loss of about 4% after sliding for a fourth time in 5 days, as recession fears triggered by aggressive rate hikes by leading central banks usurped typical optimism at this time of year from summer travel. New York traded West Texas Intermediate of WTI crude settled down 0.5% to $69.53 per barrel. Early in the session, WTI had plunged to a 3-week low of $67.36. For the current week itself, it shows a loss of 3.7%. The US crude benchmark has had a volatile month, finishing last week up 2.3% after a net 3.5% tumble over 2 prior weeks. And London traded Brent crude was down 0.4% at $74.28 versus a 3-week low of $72.12. Like WTI, it was off about 4% for the current week. The global crude benchmark was also rocky through June, finishing last week up 2.4% after a net slump of nearly 2% over 2 recent weeks. Recession fears, ratcheted by rate hikes, were also further hit by weak PMIs. And adding to recession concerns on Friday were business surveys by S&P Global, which showed Germany's economic activity lost much more momentum than anticipated in June, driven by a slowdown in services and sustained weakness in the country's factories. Separate data for France showed its economy probably slumped in the 3 months through to June. In the US itself, the S&P Services PMI flash for June came in at 54.1 versus a projected reading of 54 and a previous print of 54.9. Energy traders are worried that the Fed and friends might cripple economic growth in the second half of the year, said Moyer. Next week, the heads of the major central banks will gather in Portugal and likely signal a commitment to tackle inflation with aggressive rate hikes, he said, adding that more pessimism was likely from a global outlook due from the Energy Institute and a meeting of the World Economic Forum that will focus on energy transition from fossil fuels. Saudi targets $80 a barrel, of course, and it's just a target. The Saudis' aim of bringing oil to above $80 or keeping a barrel at least in the high 70s has proved a greater challenge than thought, despite the advent of summer travel, which typically results in peak demand for crude and higher prices. And the kingdom, which leads the 23-nation alliance of oil producers called OPEC+, has announced 3 production cuts since October that would theoretically remove 2.5 million barrels per day from its production and bring output to 9 million barrels daily by July. Crude prices have only managed to rally briefly after each announcement. Now, European shares dipped on Friday at the end of a central bank policy-packed week that reinforced views that interest rates could stay high for longer. The Eurozone flash PMI disappointed, and the euro is being hit the hardest, losing around 1%. The manufacturing PMI eased to 43.6 from 44.8. The last time it was about 50 was in June 2022. The services PMI fell for the second consecutive month, and it's now at 52.4 from 55.1 in May, and is below the first quarter 23 average of 52.8. The composite fell to 50.3 from 52.8, and it spent the second half of 2022 below 50 and spent the first half of 2023 above 50. Like the services PMI, it slowed for the second month in a row. This was the general pattern seen in the German and French readings. The manufacturing sector is contracting while services are slowing. French services PMI fell below 50 for the first time since January, and at 47.3, the composite is at its lowest level since February 2021. While Eurozone business growth stalled in June, a separate reading showed German business activity slowed notably this month. French business activity contracted as well for the first time in 5 months, and there are several headwinds, including elevated uncertainty, a drag from the US recession, the lag effects of ECB tightening cycles, and a less supportive fiscal stance, said Clemente de Lucia, senior European economist at Deutsche Bank. Until mid-2024, we expect quarterly growth rates of 0 or small positives at best. This will leave the economy vulnerable to further contractions or recessions. The Stoxx 600 index closed 0.3% lower after data showed Eurozone business growth stalled this month as the downturn in manufacturing deepened. The index has lost 2.9% for the week, posting its worst weekly performance in over 3 months, as investors digested more interest rate hikes from major central banks, including the Bank of England, Deutsche Bank and Swiss National Bank, and the spectre of elevated inflation for longer. Germany's DAX index shed 1%, leading losses among regional peers as shares of Siemens Energy sank 37.3%. The company, which supplies equipment and services to the power sector, warned that the impact of quality problems at its Siemens Gamesa wind turbine unit would be felt for years. The basic resource index fell for the 7th straight session, posting weekly declines of 7.9%. It was the worst performer of the week. GSK plc rose 4.9% after it reached a confidential settlement of a US litigation over claims that the British drug maker's heartburn drug Zantac caused cancer. And investors also worried about the global impact of protracted tightening cycles on global economic recovery, with concerns of a recession in the UK heightened by the Bank of England's larger than expected 50 basis point rate hike. A hike was fully expected, but the magnitude of the rise surprised most, said RBC Brewin Dolphin's head of asset allocation, Paul Dennis. It's quite possible that by the time the bank is finished hiking this cycle, the base rate ends up exceeding the 2007 peak of 5.75%. The Bank of England's assessment that the persistence of inflation requires further tightening helped encourage the market to discount around a 75% chance of another half-point move at the next MPC meeting on August the 3rd, and the UK has seen the flash PMI point to a slowing economy. The manufacturing PMI contraction deepened to 46.2, that's a new low for the year, and the service PMI slowed 57.7 versus 55.2. The composite now stands at 52.8, down from 54, after stalling in April at 54.9. That's the highest since April 2022. And separately, UK May retail sales held up better than expected. Rather than slipping 0.2%, retail sales rose by 0.3%. They were flattered by gasoline sales, without which a 0.1% gain was recorded. Ocado fell 5.3% in the absence of any bid developments after soaring the day before on a news report of possible takeover interests in the online supermarket and technology group. Now, most Asian stocks also fell sharply on Friday after a bigger than expected rate hike from the Bank of England pushed up concerns over tightening monetary policy, while a beat on Japanese consumer inflation also rattled sentiment. Hong Kong's Hang Seng was the worst performer in Asia, down 1.8% to catch up trades from a holiday on Thursday. Broader Chinese markets were closed for the day, but had closed lower on Wednesday, following an underwhelming rate cut in the country. South Korea's Kospi fell 0.7%, while Australia's ASX 200 lost 1.1%, even as data showed some improvements in manufacturing and service sector activity through June. Japanese stocks slid after inflation moved up more than expected. Japan's Nikkei 225 index slid 1.7%, while the Topix fell 1.5% after the data showed that consumer price index inflation grew more than expected in the 12 months to May, while core inflation read lower from the prior month. A reading that showed inflation excluding food and fuel costs surged to a 42-year high in May indicated that underlying Japanese inflation remains high. The trend points to mounting pressure on the Bank of Japan to tighten policy, even as the bank reiterated that it has no plans to alter its ultra-loose policy in the near future. The National Core Consumer Price Index, the CPI, which excludes volatile fresh food prices, grew 3.2% in May, slightly more than expected. That was meant to be at 3.1%, but following the prior month's reading of 3.4%. Including fresh food, CPI inflation grew 3.2%, below expectations of 4.1%, and the prior month's print of 3.5%, and it rose 0.1% from the prior month. The readings pushed up largely by a consistent month-on-month increase in food costs, which, coupled with fuel imports, have been the main driver of inflation over the past year. But underlying inflation remained particularly high in Japan, with an index stripping away food and fuel costs surging 4.3% in May, its highest reading since 1981. Increased services costs and house prices contributed to the high reading. High inflation could also potentially offset recent resilience seen in the Japanese economy, which had in part attracted a heavy dose of foreign buying into local stocks. Investors used the high inflation reading as a catalyst to lock in recent gains in the Japanese market. Both the Nikkei and the Topix had surged to a 33-year high earlier in the week. While global energy markets have been somewhat stabilized, after disruptions caused by the Russian-Ukraine conflict, food supply chains have remained strained, weighing on countries with high import requirements. Japan imports roughly 6% of its total food consumption. Friday's overall CPI reading remained well above the Bank of Japan's 2% target range, but the central bank has repeatedly signalled that it will not tighten policy in the near term and that inflation is likely to retreat further in the coming months. Well, we'll see. Government subsidies and electricity prices were a major downward force on inflation, as were some signs of stability in global commodity markets. But recent weakness in the yen, which was trading at over 6 months lows on Friday, may contribute to higher inflation in the coming months, given Japan's high dependence on imports. Japan saw the flash June PMI and May's CPI. Japan's manufacturing PMI slipped back below 50 in June, while moving above it in May for the first time since last October, and the services PMI slowed to 54.2 from 55.9. The composite reached an 8.5-year high in April at 54.3, and it eased to 52.3 in the preliminary June reading. The medium forecast is for the Japanese economy to be growing at 1.1% on the analysed pace in the second quarter, after 2.7% in the first quarter. The main national CPI figures were in line with expectations. The headline and core measures slowed to 3.2% from 3.5% and 3.4% respectively. The bigger issue is that measures that excludes fresh food and energy edged up to a new cyclical high of 4.3% from 4.1%. Still, next week we'll see Tokyo's June CPI, which may be more important ahead of next month's BOJ meeting, when macro forecasts will be updated. Now in Australia, a share market sell-off gathered pace on Friday, erasing a week's worth of gains for the ASX 200 as energy producers headlined the falls on a softening oil price. The benchmark index fell 1.3% to 7,099, extending the day earlier 1.6% loss and leaving the market at its lowest since it closed at 7,091 on May the 31st. The worst performing sector was energy, with oil and gas major Woodside tanking 4.6% to $32.74, and Santos was down 4.3% to $7.30. The real estate and banking sectors also declined as investors worried about the strength of the economy as the Reserve Bank of Australia lifts interest rates higher. Commonwealth Bank closed down 1.6% to $98.51. National Australia Bank lost 1.4% to $23.78, and Macquarie fell to $170.78. The risk of recession in Australia is now very high, said Shane Oliver, the chief economist at AMP. Our assessment remains that the RBA has already done enough to slow the economy and bring inflation back to target, and we are seeing clear evidence of slowing demand in terms of falling real retail sales, falling building approvals, slowing plans for growth in business investment, slowing GDP growth, and early notifications of a slowing jobs market. The worst performer on the benchmark index was Gold Road Resources, which fell 5.3% to $1.51 after it cut production guidance for the financial year 2023. And healthcare business Cochlear lost 3.5% to $227.96 after the UK competition regulator partially blocked its planned $170 million acquisition of Oticon. Elsewhere, California-based healthcare player EBR Systems has flagged plans to raise $35 million via the issue of CHESS depository instruments on the ASX at 91 cents. The raising is at a 7.1% discount to its last exchange-traded price of 98 cents. The company said the funds will be used to prepare for the commercial launch of its treatment for heart arrhythmia. In currency markets, the Australian dollar lost 0.9% to 67 cents in the afternoon, while Australian one-year bond yield lost 1 basis point to 4.37%, with 10-year Australian government bonds at 3.9399. And looking ahead, ANZ expects the May consumer price index to fall to 6% year on year when the latest inflation update is released on Wednesday. A drop in fuel prices on top of some seasonal factors post-Easter have likely led to a considerable easing in the monthly CPI indicator. However, future increases in electricity costs and housing are likely to keep inflation from falling as quickly in the coming months, said economist Adelaide Timbrell. Moreover, the Australian dollar, shares and the price of oil could be headed for a shaky start on Monday as trade is grappled with the instability in Russia, which nearly led to a bloody Moscow coup. Though, of course, that risk has appeared to pass, at least for now. Investors are awaiting two pivotal pieces of economic data this week, which could sway the Reserve Bank to lift interest rates or pause next month, as central banks keep raising borrowing costs to slay persistent inflation, pushing advanced economies closer to recession. Australian shares are expected to dip on Monday after slumping 2.1% last week. ASX futures were down 16 points or 0.2%. The monthly consumer price index for May, due on Wednesday, will reveal how well the RBA's 4 percentage point of cash rate increases are helping to bring inflation back down to target. The story, however, does not cover the full scope of Australia's CPI basket, with some components only measured quarterly. May retail sales figures due on Thursday will gauge the impact of the rising cost of living and higher rates on consumer spending. Forecasts point to a gain of 0.1% in season-adjusted terms, but I must say that the consensus range is unusually wide, with some economists predicting a 0.4% gain to a 2% fall. Inflation, retail spending and the labour market will set the backdrop for the RBA's July meeting, said Taylor Nugent, an economist at NAB's market team. Consensus indicates that monthly CPI indicators will slow sharply at 6% from April's 6.8%, reflecting falling petrol prices. NAB expects inflation to deaccelerate to 5.9%. Westpac says 6.1%, and ANZ is in line with the market median. Anything higher than 6.4% would demonstrate upside risk to the RBA's inflation forecast, he said. An AMP chief economist Shane Oliver said the market's forecast of inflation slowing to 6% annualised would create space for the RBA to skip another rate increase in July and wait until August before tightening again. The monthly inflation indicator is very volatile and is yet to really prove its usefulness beyond creating more noise for money market traders and something for economists and others to commentate on, he said. Even so, the RBA will be closely watching the CPI, excluding volatile items, because the survey is perceived as a better indicator of service sector costs. The measure stood at 6.5% in April. Futures markets imply a 45% chance the central bank will lift the cash rate to 4.35% in July and are fully priced for such a move in the August meeting. They ascribe only a small chance that the cash rate could peak above 4.6%. And in fact, economists at NAB, ANZ and Westpac are unified in tipping a rate rise in both July and August to a peak cash rate of 4.6%. Commonwealth Bank is an outlier, forecasting only a 50% chance of a move higher next month. And meanwhile, Australian bond yields jumped to a 3-year yield, climbing as far as 4.04%. That's the highest since 2011. The gap between 3-year and 10-year yields turned to minus 2 basis points. This part of the yield curve is the most watched by investors because it is a reliable indicator of a looming recession. Maybe. Now we're talking here about yield curve inversion, meaning that short-term borrowing rates exceed longer-term rates, and this month, for the first time, it's happened since the global financial crisis. in Australia. And just as important, the difference between Australian and US 10-year yields widened to 26 basis points after months in negative territory. Typically, Australian bond returns exceed US rates, but they flipped following the US Federal Reserve's aggressive interest rate increases. The Fed funds rate stands at a midpoint of 5.12%, towering above Australia's 4.1% cash rate. The sharp focus on inflation comes after the RBA's June meeting revealed the board had considered a rate pause earlier this month, while it tightened by 0.25 percentage point. Still, the RBA appears concerned about the risk of a wage price spiral and inflation expectations. Despite the policy goal to retain the labour market's recent gains, the inflation challenge is the RBA's focus, said Westpac's chief economist Bill Evans, who forecasts 2 more interest rate rises. This will certainly have an impact on households, with consumption expected to stall and gross domestic product growth slowing to a negligible pace this year and early next. But Mr. Evans suggests an aggressive easing cycle will happen early next year. Well, we'll see. Finally, Bitcoin climbed to its highest level in more than a year on Friday after surging briefly above 31,000 US. The advance stretched its weekly gain to nearly 20%. Cryptocurrency peaked at 31,410 on midday Friday in New York amid fresh enthusiasm from bulls pulling related stocks including Coinbase and Marathon Digital Holdings higher, and Riot Platforms also gained. It was last at 30,715. The outperformance of Bitcoin recently has also been tied in part to a filing last week from BlackRock, the world's largest asset manager, seeking approval for a spot Bitcoin ETF. If approved, it will be the first of its kind, and many experts believe it would increase accessibility and increase demand for the asset. So far, dozens of attempts, though, have been made to get a spot Bitcoin ETF approved, but all have failed, and the SEC has not shown signs yet that it will back down. So, in summary, this week has been a turning point. At the start of the week, it was all AI related. By the end of the week, it was all recession related and higher interest rate related. And ahead, we're clearly going to see this play out to the downside. So, as I've said recently, markets, of course, are trying to bet on the Fed not lifting rates that much, but actually are listening to what the Fed is saying. And the Fed speak is clear. We're going to lift rates higher, as other central banks are doing too. I think this is going to play out over the next few weeks in a rather ugly fashion, with the markets and the central banks pulling in different directions. But as many people say, sometimes you have just to follow the Fed because you know you can't beat them. And at the moment, my expectation is rates will go higher for longer, and recession is definitely going to be a thing. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.